Welcome to my recording on the new Nigerian tax reform that has been passed this year, signed into law. It's going to go into operation January 2026. This is a major overhaul of taxation in Nigeria, about four bills in one. But in this video, we're going to talk around the personal taxes and also the small business taxes. What it's all about, what are the changes, what should you look out for, and what should you do. Just a quick disclaimer, I'm not a tax attorney or tax advisor. I'm not giving tax advice. This is more educational. I would hope that you would watch the video, then try to, talk to your tax advisor, and of course have your own plan, right? There are four major bills in the tax reform, but if we boil it down to the personal taxes, I would say there are two key changes that have occurred that we should be aware of. The very first change is this one right here, eligible deductions, right? So what this tax bill has done is introduce eligible deductions. Some have already been deductions prior to this new tax bill, but this tax bill sort of cements it and makes it legal. And we have the eligible deductions listed here. I'm going to go into them one by one. The second major change is in the tax brackets that have been, should we say, amended in this new bill. So we now have updated tax brackets, which we're also going to talk about, and then of course tell you how that affects you. The key thing to remember is that all tax authorities tax income, right? Not assets. So we're taxing income, essentially any form of income that has come into your hands: salary, rents, dividends, coupons, fees, interest, royalties, literally any income that is going to come into your hands is going to be taxed under this new tax bill in Nigeria. Also, if you're non-resident in Nigeria and you do business in Nigeria, you may be exposed to some of these taxes. So again, get that tax advice. So let's assume you work in Nigeria, you earn in Nigeria. This is basically who we're really talking about, and these are the folks that this change would affect 100%. So I have two columns here. I've got old and I've got new. This is the old tax bill, and of course this is the new tax bill. So let's assume this person in using for an example earns ₦1 million a month. That means for the whole year he earns 12 million per year. Under the old tax regime, he would get a personal relief, 20% of gross, right? 20% of gross. And he will also get a consolidated relief allowance of 200,000 naira. So this is basically what you call above the line deductions. He's going to get this immediately before we even do the deductions, the eligible deductions. So under the old tax bill, he gets 20% of his gross, whatever that is, plus 200,000 naira, about, so give or take about 2.6 million if he was earning about 12. Literally, it accrues to you irrespective of income. It's an above the line, right? Now, we didn't have these eligible deductions in the old scheme, but like I said, pension deductions have always been tax deferred, right? Even before this new tax law was passed. So in Nigeria, you pay 18%, the employer pays 10%, the employee pays 8%, so that's 18%. So we just assume this gentleman earns 12. He gets this deduction here, 2.4 million personal relief. He also gets a consolidated relief allowance of 200,000. Essentially, we're taking 18% now off his gross, and we get 2.16 million. Then we have the National Housing Fund. What we're doing here is we're just going to take a rough 10% across the board, right? Just 10% across the board to make it simple. These are voluntary deductions, right? You can decide to do NHF, you can decide not to, but if you pay NHF, we're assuming he's going to pay about 10%. Same with the National Health Insurance Scheme, we're also assuming he's going to pay 10%. So those are about 1.2 million. Then mortgage interest. Again, this is the old scheme, right? So not really expressly stating the old scheme, old tax regime, but we're also assuming 10% here of whatever his income is going to go to mortgage. Now for life insurance premium, this is for the person, the taxpayer, and spouse. So essentially, even if we're doing 1.2 million for the taxpayer, his spouse also gets that relief as well. So we get 2.4 million there. Now, if we net off all these deductions, including the personal reliefs and the consolidated relief allowance, what we have as a taxable allowance is going to be about 1.2 million right here. So from the 12 million, if you assume this personal relief and the relief allowance, and you assume the same eligible deductions, then the taxable income falls to 1.2, which is a big fall from the 12 million, right? And then again, under the old scheme, we're going to then apply our tax brackets. So the way taxes work is that you're not taxed on the 12 million like you've seen. First of all, we remove the top line expenses, the deductions, we remove them. Then when we get your taxable income, we then do like a waterfall. So in this instance, the first 300,000, he would have paid 21,000. The next 300,000, he would have paid 33,000. How do we get that? The first 300,000, he would have paid 7% on that, so 21,000. The next 300,000, he would have paid 11, thus 33,000. Next 500,000, 75,000. So it's like a waterfall. When we tax the first 300,000, if there's still income left over, that income falls to the next level, 300,000. If there's still income left over, it goes to the next level, 500,000. In this instance, the income terminates, i.e. what we can tax terminates at about the next 500,000. So we then tax him about 26,600 on the next 500,000 after we have done these three waterfall levels. So the total income per month on the old scheme, $1 million a month. The total tax he will pay, 155,000 a month. His effective tax rate is 1.3, the take home 987 and 33 naira, 33 kobo. Now keep in mind this 1.3, we're going to use that when we go to the new scheme. Now let's come to the new scheme. What has happened, what has changed in the new scheme, and where you should look out for. Same thing, he earns the same 12 million a month. The new scheme has introduced what we call the rent deduction. So instead of the personal reliefs and the consolidated relief allowances, we now have a rent deduction. What this is 20%. 20% of the rent you pay, capped at 500,000. So it's only for renters and it's capped at 500. So if you pay 100,000, you can claim 100,000. If you pay 600,000, you cap it at 500,000. So what's the effect of this? Essentially, your personal allowances have reduced, which means what is taxable, what the taxman can assess for taxation, has gone up. So in the new tax regime, yes, if you earn above the 800,000, which we're going to see later on, your tax exposure goes up. So same thing here, 12 million in the old scheme, he would have gotten 2.6, taking away top line from being taxed. But in the new tax law, he only can potentially get 500,000. So what if you own your own home? Then of course you don't get a mortgage or the rent deduction. So that's 12 million is available to be taxed. We then go to the eligible deductions. Yes, the same thing. He's going to pay the 18% of 12 million. So that's 2.16 million. Again, we're assuming 10% for National Housing Fund, assuming 10% for NHIS, the insurance scheme for health. Also assuming in this case, now look, so we're going to talk about this. If you pay rent, you obviously can't pay a mortgage interest. So what we've done here at the very bottom, we've separated both of them, but just assume he does pay the mortgage interest, just so that it corresponds with the old. We're going to take it off at the very bottom, you'll see. Then again, the life insurance premium for both the partner, i.e. the taxpayer and spouse. So if you look at the taxable income under the new scheme, it has gone up significantly. So in the old scheme, 1.2, in the new scheme, 3.7. Why? Because the deductions, the top line deductions have been taken away. So there's more taxes that is then exposed, more income is then exposed to be taxed. So let's now go into the actual deductibles, the waterfall as it were, right? If you then look here, the first 800,000, right, in the new tax scheme is basically tax-free. So if you earn 600,000 per annum, no taxes. If you earn minimum wage in Nigeria, absolutely no taxes because it's not going to be up to 800,000. So the first 800,000 you earn in Nigeria is going to be taxed at zeros. So from this 3.7 million, we then give you a huge 800,000 that we're not going to tax. If you compare that to the old scheme, this was just 300,000. Now it's 800,000. So this sort of compensates for the loss of our, if we go back up here, it sort of compensates for the loss of our personal deductions here. The government then took it and put it back into giving you an $800,000 naira deduction right here. So the next income is going to be at 2.2 million. So again, look at here. Under the old scheme, your first 300,000 was taxed. Your next 300,000 was taxed. So more of your naira was exposed to taxation. But in the new scheme, you get 800,000 naira not taxed. Then you have to earn 2.2 to then get the second, to be at the second waterfall level to be taxed. So your next 2.2 million is going to be taxed at 15%. So this guy earns about 3.7 million. His first 100,000, he gets a tax-free pass here. But the next 2.2 million, he does pay 15% tax. So he pays 330,000, right? The next 9 million, he then pays 18%. So you're seeing the bands are wider in the new tax law. In the old tax law, I mean, your first 300 was taxed, next 300 was taxed, next 500 was taxed. But in new tax law, you've got to earn about above 800,000 to be taxed, to then qualify to pay taxes, more or less. So the total tax this gentleman pays is going to be here 463 and 200 naira. His total income is $1 million a month. He pays the 463, 200 a month. His effective tax rate has gone up to 3.9. Why? Because more of his income is being taxed, because the deductions here, the 2.6 that you would normally get in an old scheme, have been taken away, but have been replaced with giving you a rent deduction if you pay rent, and also giving you a huge 800,000 tax-free income waterfall number. If you then earn about $1 million, of course, that's going to be a huge deduction for you. So the effective tax rate on the new scheme does go up. So what we've done here in this little blue column is we've taken away the rent, because we've said if you look at the rent number and you look at the mortgage interest number, again, guys, what I'm trying to say is the rent number here for 500,000, in my view, is always going to be less than the mortgage interest that you're paying. So like if you borrow 25 million, how much do you think you'd pay, say, in a year? Even if you pay 10%, that's 2.5 million. I think it's always going to be more than the 500,000 naira cap. So it's always, the way I've done this is to say I've assumed that everyone's going to choose the mortgage interest, or there's going to be a mortgage interest deduction, right, which is more than the rent deduction. If you did that, then the numbers just change slightly. In this instance, it changes to his total tax paid going up to 481, and his effective tax rate going up to 4%. Why is his tax rate going up to 4%? Because he's not taking this rental. He's not taking the top line deduction here. Rather, he's taking the mortgage interest deduction under his eligible deductions. He's not taking his rental, hence his tax number here is going to go up to 4%. Marginal when you say 3.9 to 4. But the key thing for you to understand is that if you own your own home, you do not get the 500,000 naira deduction. You only get the mortgage interest deduction. And if you then pan that out, your effective tax rate goes up because you don't get a deduction. But if you rent a home, then you get the deduction capped at 500,000, and it does reduce slightly. If you compare both of them, i.e. paying rent to paying a mortgage, paying rent gives you a higher deduction. But when you compare it to the old scheme where you got the gross deductions right here, where you got the personal reliefs and the consolidated relief allowance, the old scheme gave you a larger allowance, more or less. So what's the learning from this? If you own your own home, you can claim the mortgage interest. If you don't own your own home, you can claim up to 500,000 via a rent deduction, and you have to do your eligibles. You've got to make sure you claim as many eligibles as you can, because this bulk 20% of the gross deduction has been removed. You no longer get it in the new scheme. So you've got to go and start to claim all these deductions in the new scheme. The point is, if you are working right in the old scheme, if you do the pension scheme, you did a housing scheme, or you did not, you still got your 2.4 right there. But in the new scheme, it's not given to you. You've got to go claim your 2.4 and your 200,000 naira here in how you spend your money. So taxes are not just to raise income, it's also to drive behavioral change. So what the government is saying to you is that we want you to contribute to pensions, we want you to contribute to the housing fund, we want you to have life insurance, we want you to try to buy your own home, and we want you to buy, of course, life insurance for yourself and your spouse. If you do this, then we give you that deduction that you have lost in the old scheme. So very important that you've now got to go out and reduce your taxable income by buying or investing in these eligible deductions. You're no longer going to get it automatic at 2.4. That's the key first lane. I'll just make sure you guys take away from this. You've got to go out and buy these to then qualify for to increase, or to should we say reduce, your taxable income. Very, very important. Let's talk about the tax brackets in more detail. So what I've done here is I have put both the old and the new scheme, but what I've done is I've put the eligibles here at 0 and the eligibles here at 10. What I mean is I have assumed that this fellow here has not taken any eligible expenses, while this guy has taken, just like I said, 10% right across the board. So again, the numbers are not the issue, is the principle I want you to focus on. So if you're taking 10, 15, it's not the issue, it's the principle of you going out to take your eligibles. So let's pick a guy. Let's pick this guy earning about 100,000 naira a month. This is the old scheme, and he's doing this without eligible expenses. So he earns 100,000 a month. He's going to earn 1.2 a year. His old taxable income is 760. The new taxable income is 1.1. Why? Because we've removed, like we saw in the previous slide, he has less bulk deductions ab initio top line. He's got to go out and buy. So because of that, his taxable income is increased, right? So if you then pan it all out here, the old tax he pays 6.5, the new tax is going to pay 3.7. Again, look at this. He's going to pay less taxes under the new scheme than the old scheme. Why? Because we're giving him 800,000 to say if you earn 800,000, you will not pay a tax. In the old scheme, if you earn 300,000, you get taxed. But in the new scheme, 800,000. So you see here, his old tax rate is 6.5. New falls to 3.8 because of that whole 800,000 allowance. Remember that no eligibles. So the tax paid on the old scheme goes up, tax paid on the new scheme goes down. His old take home was 93, his new take home was 96. So if you are earning like a little, very minimum wage in the old scheme, this new scheme benefits you because you get that 800,000 naira deduction ab initio. So if you were in the old scheme and you were earning 100,000, the new scheme is better for you. But let's move on to a guy earning about 2 million a month. So every year he earns 24, right? Again, no deductions, no eligible deductions. So under the old regime, he would get a taxable income of about 18.96 million. The new regime, he would pay 23 million. Why? Because now the deductions work in against him. He's lost his 2.6 deductions above the line. He only has the 800,000. Because he loses that, his taxable income has gone up. So the tax rate, of course, is slight change, 18.10 to 18.50. And that shows up in the tax paid and the take home. So again, if you earn higher than the minimum wage, right? If you're like middle income earner in Nigeria, the new tax regime will tax you more because your above the line deductions have fallen from about 2.6 to just 500,000 naira if you rent. If you don't rent, you've lost that completely. You don't have to go into your eligibles, which is why you see the rent go up if you earn more. And you look at it clearly, to a guy earning 10 million or 5 million, again, no eligible deductions, but look at their taxes. It's gone up from 18.6 to 21, 18.8 to 23. Why? Again, the deductions are not being taken. The top line, the 2.6, the 20% gross is not being taken. So that increases the taxable income in the new scheme. So the summary is this. If you are a minimum wage earner or you earn very little, this new tax regime favors you because your deductions, your 800,000 naira that you have to earn before you pay tax favors you. So your taxable income falls. So it favors you. Your tax rate is going to be lower than the tax rate in the old scheme. But if you earn more, if you're a high income earner, of course, this new tax regime exposes more of your income to taxes because we removed those deductions ab initio. Let's look at this exact same scenario, but now let's apply the 10% eligibles across the board. Again, guys, forget about the 10% per se, the calculations. Look at the principle of what we're going to teach about, right? Now, if you apply the 10% eligibles, this gentleman that earns 100,000 a month, 1.2 a year, he pays absolutely nothing. I mean, there's no taxable income whatsoever. Why? Because he not only does he get the 500,000 naira rent, because we're assuming at this level he's renting. Not only does he get the 500,000 rent, he also gets the 800,000 income level deduction. So he pays absolutely nothing. Both old and new, they will pay absolutely nothing because why? We've added the eligibles. So eligibles change the entire equation. So for a low income earner with eligibles, nothing is paid. Let's go to our 2 million naira lady that is basically earning 2 million naira a month. So a year, 24 million. She applies an eligible of 10%. So she's paying maybe 10% NHIS. She has a retirement savings account with the PFA. She has a Nigerian health insurance scheme. She's also buying insurance. Just those eligibles. She applies those eligibles. Again, not the number per se, but the principle. Her old taxable income, 5 million. The new taxable income, 1 million. Why? Because when she applies those deductions, it reduces her taxable income. In the old scheme, the deductions were still there, but more of the income was open to be taxed. In the new scheme, there's less of the income if you apply the deductions. If you don't apply the deductions, if you compare the same person up here, the same 2 million here, about 23 million is available to be taxed. But here, if you apply just the 10% deduction, it falls from 23 million to about 1 million because we've taken away a lot of the income. We've taken away a lot of this 24 million. We've said we're not going to tax that 24 million because we're going to pay NHF, we're going to pay pensions, we're going to buy life insurance for spouse and taxpayer. So that reduces this. And that's the principle we're trying to teach here. So the old tax rate, yes, it does go up. Of course, you pay more. Like I said, why you pay more? Because you have less above the line deductions. But with the eligibles you purchase, 6.7 is less than 18. And that shows up in the numbers right here. Again, go to the lady also earning 10 million a month, earning 120 a year, applying eligibles. The taxable income, of course, goes up when compared to the old regime. Why? No deductions. No deductions, right? Above the line deductions are less. But when you compare 50 million with 119 million, you then see the power of the deductions. So instead of you paying a 23% tax rate, you're only paying an 8% tax rate. Again, not the numbers, because some folks are gonna pay less or more in eligible. Someone's gonna say, I'm gonna pay maybe 20%. I'm going to make an additional voluntary contribution to my retirement savings account, so it would increase by 20%. That's fine. But the principle is, if you do not take your eligibles, when we mean do not take, if you do not go to the marketplace and register for a retirement savings account, buy a national health insurance scheme, or buy life insurance for yourself and your spouse, then your effective tax rate is always going to be higher than if you bought them. This is the key learning here. The first learning was that, of course, if you own your home, you've lost the huge chunk of your deductions. So if you're a higher earner and you live in your own home, your taxes are going to go up. But if you're a lower earner and you're paying rent, your taxes are going to go down. And the second point is eligibles. If you do not have eligibles, your taxes are going to be really, really high. So what's the two learnings here? Number one, you've got to really, I won't say go rent a house to get that deduction. I wouldn't say that. If you own a home, you've got an asset, that's fine. You've lost the 500,000 naira deduction, that's fine. But you must go buy the eligible deductions. You've got to go buy the pension from a retirement, go to a pension fund administrator and open a retirement savings account. And I would even say seek to do additional voluntary contributions, because when you do more additional voluntary contributions, you are removing or reducing your taxable income. So you do your additional voluntary contributions in addition to your regular retirement savings account contributions, which is your basic housing and transport. You've got to make sure your employer specifies your payroll in terms of basic housing and transport, not just say you earn X amount, but it has to be specified basic housing and transport. You've got to go buy national health insurance scheme. You've got to go get that because that's also going to be eligible. You've got to look into buying life insurance for yourself and for your spouse, right? You've also got to do the National Housing Fund. Again, this is all voluntary, but the more you do them, then of course you are reducing your taxable allowance. That's essentially what it is. The more you buy the eligibles, the less your taxes. Okay, let's talk about small business because this is all mostly the individual, right? Let's talk about small business. If you notice, I saw on social media this guy that does skits was charged 36 million, assessed 36 million to pay taxes. And he's complaining where am I going to get that money from and all that. So how should you approach your business going forward on a new tax scheme? I would say the first thing you want to do is to go set up a company. So if you are doing any commercial activity, you've got to do that under incorporation. Why? Because once you're incorporated, if you have a turnover of less than 50 million, you don't pay tax. You don't pay tax on less than 50 million turnover. So that is a huge tax break right there. If you go back to this guy, he's earning about 120 million. Let's even use this one, 120 million. His tax is about 8.8. If he was earning these funds under an incorporation, so Mr. and Mrs. Limited, then if this was turnover, then he would pay zero here, subject to certain clauses which we'll talk about right now. So first things first, you've got to set up an incorporated entity to do your business, right? If you're an accountant, set up your accounting firm and you want to pay incorporation, company income tax and all that, right? So that's the first thing you want to learn. Now, exactly the same thing that occurs here, i.e. your eligibles reducing your taxable income, is exactly what the business guys are going to do as well. When you set up a business, you're going to earn a gross income. That gross income is then going to be exposed to taxation. But you can reduce that gross income by netting off eligible expenses. So if you make pure water, you made turnover of 60 million. We know 50 million is going to be taken away. You're not going to pay on that 50 million. The remaining 10 million is exposed to taxes. Then you tell the taxman, oh, I bought nylon bags for 8 million. That's an expense that you're going to wipe off because that's the cost of doing business. So you say your 60 million, you wipe off your 50 million, that's 10 million now, which is your taxable income. Of that 10 million taxable income, you bought pure water for 8 million. So you're now going to be exposed to pay tax on 2 million. But you've gone from 60 to 2. So those expenses, how is a tax man going to look at it? There's a principle called the WREN principle. So the tax man is going to ask you, is the 2 million you spent, sorry, the 8 million you spent to buy pure water and nylon bags, was it wholly used for pure water manufacturing? So I bought all the pure water bags, they were for pure water manufacturing. Yes, so he agreed with you. Is it reasonable? Yes, my only input is pure water bags and water and purifying chemicals. So that's a reasonable expense. Yes, he agreed with you. Is it exclusive to that pure water factory? Or are you buying nylon bags maybe to go and to do some other thing that is personal to you? If it's exclusive to the pure water factory, he agrees with you. Is it necessary? Yes, I can run a pure water factory without buying polyethylene bags. So you have to qualify this wholly reasonable, exclusive, necessary in every expense that you want to use in your business to knock off taxes. What this means is very, very simple. If Davido buys a Ferrari and says that Ferrari is for his business, the taxman will say, is it a wholly related expense? Of course, he's a rapper, he's a musician, he's an entertainer, he needs a Ferrari. Is it reasonable? Yes, he has to look good for his music videos. Is it exclusive for use of his videos? Yeah, he uses it in his videos, he drives around, he's always doing PR. Is it necessary? Yeah. He's an Afrobeat guy, he has to look flashy, his game has got to be tight. So a Ferrari for Davido, for Burna Boy, for Wizkid, for Thames is fantastic. A Ferrari for an accountant, is it wholly for the business? Is it reasonable? Is it necessary? Does an accountant need a Ferrari? I don't think so. This is where you now fall into trouble with a tax guy, that whatever you spend has got to be reasonable. What about if I buy designer shirts? If I'm an accountant and I'm buying Hugo Boss white shirts, that is wholly for the business. And when white shirts on my clients think I know I look nice, so I look very professional. Is it reasonable? I mean, I can argue it's reasonable. I want to look rich, so I can manage rich folks. Is it exclusive for the business? Well, I don't wear a suit to swim or to go to the village. It's only to when I go for meetings. Is it necessary? I can also make the argument that yes, I want to look good. So when I see Mr. Dangote, he sees me looking good. He can do business with me. So for an accountant buying Hugo Boss suits, Hugo Boss shirts, you can make that argument. For Davido buying a Ferrari, he can make that argument. So whatever you spend money on, make sure that it is, of course, wholly reasonable, exclusive, and necessary. The second is the VAT rule. The VAT rule is very, very important, guys. It's saying that any expense or asset you want to claim tax on, you've got to make sure that you've paid VAT or import duty on it. So go back to Davido's Ferrari. If Davido buys a Ferrari and he passes the REN principle, but he didn't pay import duty, then he cannot use that Ferrari to write off his income. So whatever you want to use, if you want to buy a laptop to use as an accountant, you've got to pay VAT or import duty. Very important. What does that mean to us? It means we've got to keep records. Anything we buy that we want to use to write off on our taxes, keep the receipts. Scan the receipts, keep them for the tax man so you can make this argument. Then interest and royalties for non-resident companies not deductible. In essence, what I'm saying is this. Davido has Davido UK, Davido US, maybe where he does his concert. Davido UK cannot borrow money to Davido Nigeria. Then Davido Nigeria will say, oh, I'm paying interest to Davido UK, so I want to write that off my expenses. No. These are related companies, so we're not going to allow you to do that. You know, there has to be arm's length contract. You can't say, oh, Wizkid Nigeria is paying Wizkid US royalties to use the Wizkid Ojuelegba name. No, they don't want that. You know, it's got to be arm's length and all that. Non-deductible expenses. There are a few things you cannot deduct whatsoever. You can't deduct personal costs. You can't deduct connected party payments. You cannot deduct payments and fines. You can't deduct non-compliance, VAT, and import duties. Like we've explained, if you are fined, you have to pay. It doesn't matter. You know, if you have a connected party transaction, even though it is legal, even though it is wholly reasonable, exclusive, and necessary, you can't deduct that. Your personal cost, if you're hiring a private jet to go to a holiday, that's personal to you. You can't deduct that. So, I mean, look at it this way, right? For the business, it's a very simple thing they're asking you to do. Incorporate a company, keep your expenses. So when you file your taxes, you can make this argument if it's wholly reasonable, exclusive, or necessary. That's essentially it. I'm not a tax guy. I'm not going to tell you go incorporate. That's what your tax guy is going to tell you to do. But on a personal level, this is what you have to do. When you want to buy anything for the business, ask these 4 questions. And you want to buy things in the name of the business. You want to buy those cars in the name of the business. You want to do your transactions in the name of the business. Your phone that you're using to make calls, to make deals. Who owns that phone? Is it you or your business, right? The little shop that you go to, who owns it, yourself or the business? Remember, exclusively. So if you walk to the answer, you allow these eligibles to reduce your taxable expenses. This is not going to be we're not teaching you tax policy, we're teaching you behavioral, how you want to behave to ensure that you are wholly, reasonably, and exclusively and necessarily spending to ensure you don't incur taxable income. What the taxman is looking for is not income per se, but taxable income. Keep that in mind. Let's close with a to-do. What are you to do today? 1, like I said, incorporate a business. If you think your turnover is going to be more than 60 million, incorporate a business. This is going to change how many people approach your business. If I worked for a company and I earn 100 million naira, can I talk to my company and say, I want to go set up my own company and you guys pay me as a consultant? You don't pay me a salary. You have to have these conversations. I'm not saying you should, but have that conversation. So incorporated business allows you to get that 50 million deduction, grandfather deduction. Very, very good. Number two, keep proper books of accounts. Not the analysis per se, just keep the books, your receipts, and all that. If you go spend with the card so it's tracked and recorded. If you have a receipt, scan it, keep it. Don't just keep paper. It could get lost, bro. So keep all expenses, because those expenses now go back to your income, where you then argue it is exclusive, it's reasonable, and all that. Of course, last is hire an accountant or financial advisor. We don't want to teach you tax policy here. We're sort of showing you the two major changes that have occurred in Nigeria. And of course, we're then showing you how you can sort of get yourself right. So the key thing, like I said, first of all, is that remember the tax law has removed, let's go back and just do our summary. The tax law has removed this 2.6, the 2.4 million, the 20% of gross personal relief is gone. The considered relief is also gone. So you've lost these two. It's been replaced with a rent deduction of 500,000. So if you don't rent, you don't get it. What that means automatically is that if you earn higher under this new tax regime, you pay more. But if you were earning less, below minimum wage or at minimum wage, you pay less with this new tax reform. The second thing we brought to you guys is to say, listen, you've got to go buy your eligibles. If you don't buy your eligibles, i.e. your pensions, your insurance, your housing funds, if you don't contribute, you expose more of your income to be taxed. And the numbers are crazy. I mean, 23% vis-a-vis 8%, 16% vis-a-vis 5%. You've got to really go buy eligibles. Then if you're a business, or if you're doing skits, or you're doing a business, you're an accountant, set up your own company if possible. Set up your company so that number one, you get the 15 billion naira deduction, and number two, you can then plow more expenses into the business to then reduce your taxable income according to these principles. The rent principles, the VAT rule, you've got to pay your VAT and your import duties. So don't buy anything without paying VAT or making sure there are no import papers. Be careful about doing third-party transactions with related parties. And of course, do not deduct personal expenses, connected party expenses, fines, and non-compliant VAT and import duties. And last, and most importantly, this number 3 point, hire an accountant or financial advisor. Make sure you have someone looking at your account and how you are spending money. This is just the first year. I can assure you this tax is going to be revised once, twice going forward, because lots of things are going to come up. For instance, if I am married and I have 4 wives, do my 4 wives all get and I keep them in 4 separate homes? Do I get rent for 2 million or do I get 500,000? Many things are going to come up, right? Which the tax guy is going to give guidance to and will change most of what we're doing. So we're not going to talk about the tax law per se, but it's a very, very simple thing that even you as a non-tax person can do. Incorporate a business if possible, keep your books of account, take your eligibles, make sure you are reducing your taxable income by ensuring that you are taking all those eligibles, and of course you are paying less taxes. This is all legal, and you've got to really invest in knowledge so you can basically have more of your income to spend on yourself, your family. And remember, taxes are not bad. Taxes fund the government, so we all want to pay taxes, but we also want to work for you as the individual to also keep more of your money so you can spend. Thank you guys for hanging out with me. Again, my name is Kalu Aja. You can follow me on Twitter on @FinPlanKaluAja1. Also do a podcast the way I see it. So do follow. Also got a book on Amazon. Let's talk about your money. I'll be so glad if you guys could follow, buy, or read any of my written and spoken material. Do have a good day, guys. I'll see you guys next time. Bye.